Joining us today is legendary investor Don Coxe and the chairman of Coxe Advisors. He joins me on the line now. Don, good to speak with you again.
Hi, Daniela.
Don, happy to have you on and talk about what's happening with the gold price today. Gold hitting fresh 4-year lows on Wednesday. Don, what do you make of what we're seeing in the gold market?
Well, first of all, when I left doing a television show today, gold on a year-to-date basis was down 3%. People forget that. So my view is that, yes, I've been disappointed in this, like everybody else, I guess. But let's not overdo it, because it is still not down as much as a lot of other things and a lot of other commodities. In fact, it's been one of the best performing commodities this year.
Don, perhaps it's not so much the 3% that concerns investors, but the fact that gold is down to the lowest levels last seen in 2010.
As of this morning, if you did a 4-year chart, you'd find that gold and oil were right back to where they were 4 years ago. So that's a good correlation to have. And so I think that when we've had bursts of inflation, and everybody goes back to what happened in the 70s, and that's where I started in this business. But remember that gold was coming off having been constrained since the 30s. And so when Nixon closed the gold window, then what happened was gold had a lot of catch-up to do. So it went from $35 an ounce to $800, and then entered a long bear market. Well, in this millennium, it's gone from like 275 up to 1900, and sure, it's pulled back, but it's hugely outperformed stock markets of the world in this millennium. It's entitled to have a pause in here.
Don, and I like the way you phrased that perhaps gold does deserve a pause, but one sector that has had too long of a pause perhaps is the mining sector, Don, and for the past 2 and 3 years, I've interviewed analysts who have said, well, look at it as a great buying opportunity, but these stocks continue to underperform. When do you think we could see a turnaround here for the mining stocks, or is it just really impossible to tell right now?
Well, Daniela, we've always said that the key to investing in mining stocks is the value of unhedged reserves in the ground in politically secure areas of the world. And what we now know is that we have run out of high-grade gold deposits in the world. But look, when this all began, they will go back to the year 2000 when people had given up on gold. Nobody opened a new gold mine without at least 6 or 7 grams per ton. If we had gold mines operating now that were 6 and 7 grams per ton, they would be making a lot of money at these prices. But we don't have them anymore, and therefore the basis for the next long-term bull market in gold mining stocks is when people realize there are no good new gold mines in safe parts of the world that have high grades. It's all been gone. We've harvested all that. It's now ending up in bank vaults and in central banks owning it.
And so what can this tell us about the gold price moving forward?
That shows you how truly scarce gold is. And therefore, in the next 14 years, if we're going to use that, I have no doubt the gold prices are going to tremendous new highs because the world needs gold, no doubt about that, and there just aren't any high-grade deposits in politically secure areas of the world.
Finally, one last question before we wrap, Don. We saw QE end in the U.S. last week. At the same time, the Bank of Japan announcing more quantitative easing, and we'll see what Europe has in store on Thursday. What do you make of what we're seeing on the world scene here?
Well, that's the other part of the story, is that, again, it's almost as if the gold market was being driven by children who are saying, I want it all now. I don't want to have to wait until I get older, Daddy. All right, give me my money now. Because when you quadruple the size of the Fed's balance sheet and the Bank of Japan balance sheet, which is merely the 4th biggest economy in the world, all the balance sheets out there are vastly bigger than they were. So the only reason why this hasn't triggered inflation is because we have these powerful deflationary forces from government debts and government intervention and public sector unions and all those things which have been preventing growth. But at some point, growth will come back. And when it comes back, the ratio between the combination of government debt outstanding and central bank balance sheets relative to global GDP will be an all-time high. And so when that next growth move comes, it's going to be a dandy simply because we've quadrupled the liabilities in relation to the assets. So it's not a matter of if, but when.
On that note, thanks so much for joining us, Don. It's always a pleasure speaking with you.
That was lovely working with you, Daniela. Thank you.
And thanks for watching this edition of Kitco News with Don Coxe. We'll see you on Thursday.